Investment and financial planning. Diversification, spreading investments across various asset classes to reduce risk. Example, an investor buys shares in technology, healthcare, and utility companies, along with some real estate and government bonds. If the tech sector experiences a downturn, the gains in healthcare and utilities can offset the losses. Compound interest, earnings on an investment's interest which is reinvested to generate additional earnings over time. Example, if you invest $1,000 at an annual interest rate of 5%, you'll have $1,050 after 1 year. In the second year, you earn interest on $1,050, not just the initial $1,000, leading to exponential growth. Risk and return, the principle that potential return rises with an increase in risk. Example, investing in a startup company might offer high potential returns if the company succeeds, but it also carries the risk of losing the entire investment if the startup fails. Dividend reinvestment plans, DRIPs plans that allow investors to reinvest their dividends to purchase more shares. Example, an investor owns 100 shares of a company that pays a $1 dividend per share. Instead of taking the $100 in cash, the investor uses it to buy more shares of the company automatically. Bonds, debt securities that pay periodic interest and return the principal at maturity. Example, a $1,000 bond with a 5% annual coupon rate will pay $50 in interest each year until it matures, at which point the $1,000 principal is returned to the bondholder. Stock market volatility, the stock market can fluctuate significantly in the short term. Example, the stock price of a company might drop 10% in a single day due to unexpected bad news but could recover and even rise higher over the next few months as the market absorbs the information. Stock exchange, a marketplace where securities are bought and sold. Example, the New York Stock Exchange, NYSE, is where investors can buy and sell shares of publicly traded companies like Coca-Cola and IBM. Mutual funds, pooled investments managed by professional fund managers. Example, a mutual fund might hold a diversified portfolio of 100 different stocks and bonds, allowing individual investors to benefit from diversification without having to buy each asset individually. Asset allocation, distributing investments across various asset categories to align with financial goals and risk tolerance. Example, a 30-year-old investor with a high risk tolerance might allocate 80% of their portfolio to stocks and 20% to bonds, whereas a 60-year-old nearing retirement might choose a more conservative 40% stocks and 60% bonds allocation. Market sentiment, the overall attitude of investors toward a particular security or the market as a whole. Example, positive news about a company's new product launch can create bullish market sentiment, driving up the stock price as investors rush to buy shares, anticipating future profits.